To please get seated. We'll be starting in a couple of minutes and we'll proceed with the next category of awards, requesting everybody to please get settled. Once again, I'll request everybody to please get seated as soon as possible. Beautiful ladies to please get settled. We'll move forward with our next category of awards. To announce the winner of the Growth Capital Investor of the Year 2025, we invite on stage Farzana Wadia, Head Brand Capital.
The Growth Capital Investor of the Year award goes to Amicus Capital.
To receive the award, we invite on stage members of the Amicus Capital team, Abhijit Naik, Director of Finance and Administration, Amicus Capital. Congratulations, team Amicus. A couple of words from you on the award and the year that 2025 was.
Thank you. Thank you. It's an honor to receive this award on behalf of my GPs and the entire Amicus Capital team. I'd like to thank Venture Intelligence for this recognition. Thank you. This will make a great social media post. Thanks.
Indeed, it should. To announce the winner of the Private Equity Fundraise of the year 2025, we invite on stage Ghana SK, Advisor Venture Intelligence.
Good afternoon. I'm delighted to announce the Private Equity Fundraise of the year 2025 award. The award goes to Chris Capital.
To receive the award, we invite on stage Rajiv Batra, Director, Chris Capital. A hearty congratulations to Chris Capital. Rajiv, a couple of words from you on the award, please.
Thank you so much for bestowing this, I think, honor at the firm. I think all of us here are very happy to receive it. And I think the relevant recipients of this, right, Gaurav and Saurabh, who lead the fundraising, are not here. I think they are the reason I think all of us on the investing side get the fuel to do what we do so that we can at least get good returns for our investors. Thank you once again for this.
The final award of APEX'26 is Private Equity Investor of the Year 2025. I'll again request Mr. Ghana to please give away the award.
Good evening. The Private Equity Investor of the Year 2025 award winner is Motilal Oswal Alternates.
To receive the award, we invite on stage members of the Motilal Oswal Alternatives team, Rohit Mantri, Co-Head and Managing Director, Private Equity, Vijay Dhanuka, Co-Head and Managing Director, Private Equity. Congratulations, team Motilal Oswal Alternatives. A couple of words from you.
Couple is literal, but thank you, Venture Intelligence, for bestowing this award. I think on behalf of Motilal Oswal Alternates, really thankful to everyone in the ecosystem. It has been a great year for us for raising our fifth fund as well as trying to do a good amount of investments and exits. Hopefully we will continue the same action in the current current calendar or financial year itself. Thank you once again. Thanks.
Thank you so much. With that, I would like to call on stage the speakers on the final panel of the day, Focus on Private Equity. I would like to call Preeta Jha, Partner, Pioneer Legal, who's also the moderator, Rajiv Batra, Director, Chris Capital Advisors, Pancham Mukim, Head of Private Equity and Senior MD, Everstone Capital, Srinivas Bharatam, Managing Director, Stake Board Capital, Tarun Bhatia, Regional MD and Co-Head of APEX'26 Investigations, Diligence and Compliance Crawl. I request all the panelists to please come on the stage.
एक मिनट लाइन में जी छुक 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 छुक
I would now like to take the pleasure to do the introduction of our moderator. Preeta Jha is a co-founder and partner at Pioneer Legal, specializing in private equity, strategic mergers and acquisitions, and corporate advisory practices. With over 16 years of experience, she has played a pivotal role in numerous domestic acquisitions, joint ventures, private equity investments, and complex cross-border deals. In addition to her core transactional practice, she provides strategic legal counsel to advertising agencies, media houses, and entertainment sector clients on commercial contracts and operational legal matters. Over to you and the panel.
Good evening, everyone. Am I audible to everybody? Is it better? Is it better now? Sounds good? Good evening, everyone, and welcome to our panel on private equity. We are unfortunately missing one of our panelists who will join shortly, I assume, but in the meantime, the four of us can get started. To give a brief introduction, India's private equity market, we believe, is at a very interesting inflection point. We're seeing continued long-term optimism on India, but also a much sharper focus on capital efficiency, governance, diligence, value creation, and exit readiness. Sector conviction, of course, is always evolving. Underwriting assumptions are changing, and investors are becoming more and more selective about where they deploy capital. What makes today's panel more interesting and especially valuable is the range of experience and the depth of experience that we have today, from leading private equity investors across growth and buyout strategies to a senior expert in investigations, diligence, and compliance, who I'm sure will join us soon. Over the next hour, we'll be exploring where capital is moving in India, how investment theses are evolving, what investors are prioritizing in promoters and management teams, and what risks are becoming more and more important in execution. Let me first introduce our panelists. We have Pancham Mukim, Head of Private Equity and Senior Managing Director, India at Everstone Capital. Pancham leads Everstone's private equity investments across sectors, including healthcare, pharma, consumer, and brings over 20 years of investing experience, including prior roles at Warburg and JP Morgan. Welcome, Pancham. Joining him today is Rajiv Batra, Director at Chris Capital Advisors, where he focuses on consumer investment opportunities. Prior to Chris, Rajiv worked with Premji, earlier with Antarctica Capital and Temasek, bringing a strong multi-platform investing perspective. Next, we have Srinivas Bharatam, Managing Director at Stakeboat Capital, a private equity firm focused on growth and buyout investments in middle market companies. Srinivas brings over 30 years of experience across private equity, venture capital, credit rating, advisory, and corporate finance, with leadership experience across multiple investment platforms. And joining us in style today, our last panelist, Tarun Bhatia, Regional Managing Director and Co-Head of APAC for Investigations, Diligence and Compliance at Kroll. Tarun leads the practice in India plus APAC and brings over 25 years of experience advising investors and corporates on diligence, investigations, disputes, and compliance risk in complex transactions and operations. Let's kickstart the panel with my first question for Pancham. Given your investing experience across sectors, healthcare, pharma, consumer, how is Everstone thinking about sector conviction in India today, and what do you think has changed over the last 12 to 18 months in terms of what gets you to saying yes to an investment in an asset?
Thanks, Preeta. Hello. Thanks, Preeta. I think a few things. As Everstone, we are reasonably focused investing shop. we don't like to meander from what is generally predetermined strategy on what sectors we want to look at. And we focus on 4 or 5 areas, healthcare being one of them, technology, the second one, industrials, and then incrementally fin services and maybe even consumer. But those are more opportunistic. The 3 spaces, healthcare, tech, and industrials, are our main focus areas. And within these sectors, these are very large spaces by themselves. If you take healthcare, for example, it's not one sector, right? Healthcare services, which is hospitals and diagnostics, is one piece. Life sciences, which is very dissimilar to hospitals, and then you have med devices, you have nutraceuticals. So within each sort of domain, you have multiple subspecialties. And over the last decade odd, the way we've come to define ourselves is we are domain experts. We've been, 70% of what we do is between 3 areas for most parts, right? And we build businesses in both healthcare and tech, and we'll be able to sort of understand product formulations in pharmaceuticals, for example. So as we look at these sectors, we know the defined areas that we want to focus on within each of these sort of spaces. And what gets us to say yes, I think that's a very long process. But what gets us going or started on an evaluation is if it meets certain filter management teams, right? Are they already in place? Do we have to build them? What's the depth of that dive in institutionalizing a business? Second, scale, right? India in the last 10 odd years is re-rated not only on multiples but also on scale. Mid-market private equity would have been $10 million EBITDA business or a $7 million EBITDA business 10 years back, but today it's probably a $20 million EBITDA business. So mid-market private equity itself has re-rated and scaled up along with the multiples having scaled up. And as we sort of go about that, we change our sort of filters of scale on what is the right size business that we want to buy into. And a peculiar thing has happened in India over the last 7-8 years, especially post-COVID, where profitability has grown faster than revenue for a lot of companies, right? And as margins expand, EBITDA grows faster, revenue grows slower. But remember, organizations are anchored to the revenue, the scale, not to the EBITDA. And that sort of then changes the effort you have to put as you then eke out incremental EBITDA growth from businesses. So we are very mindful of that effort that we have to put in. Scale of at least $12 to $15 million in any business that we look at. Growth metrics. We are not guys who sort of get out of bed on just hyper growth of any asset. We need cash flows. We need good ROC. We can compromise on growth not being 40% if it's 18%, 20%, but we'll need free cash flow coming out of businesses, right? So we are a little more conservative on that part. Like to keep our sort of type 2 errors low, 0 loss ratios. That's our deal type. That gets us to start evaluating a business within our spaces, meeting these size and management quality criteria, and then sort of financial metrics from there onwards.
It's interesting, Pancham, that you mentioned that you are now looking at building businesses. I think that's a very different lens from which private equity was seen perhaps 15 years ago, where investors were more than happy to just invest and play a passive role in watching management run the investment theses. We are now seeing more and more control deals happening where investors now play a real role in the growth of the investment. Is that a strategy that you employ as well?
100%. We are 100% controlled growth private equity firm. We only do mid-market buyouts effectively. Sometimes we back existing management that is already running the business, but in a controlled position. Sometimes we hire new talent to run businesses. Oftentimes we institutionalize a business, taking control and transitioning the business from founder-driven setups to more professionally run businesses. That's a big part of what we do. right? And as we've been doing this for some years now, we've sort of built our niche in institutionalizing businesses, right? And we don't meander from the control strategy. We will not even make an exception on doing a single minority deal, however attractive that business a business may be. We don't move the core strategy of our business, because if we make one exception, there'll be 3 other ways to find another one, right? And we have historically been business builders. We've just refined that approach now. We built Burger King in India. It was started from scratch by Everstone, where we had a master franchise and just a paper contract, and we built to what is 500 plus stores now, right? We built multiple other businesses. We've transformed Sayadri Hospitals, where we used to own 90% plus stake, and the way we had sort of orchestrated our approach in tougher times, right? When COVID hit the first phase of COVID and lockdowns were on, right? People were not able to get to hospitals, right? At that point in time, you have debt in the business, you have cash flows to sort of take care of, and you get to the daily MIS levels of a business. What do we do today? What do we do today? We can take daily decisions and sort of help management teams, hold their hands in very, very tough times. Parachute in, but parachute out again when we need to. So we can behave as co-promoters often in the business if the need be. We would not want to do that always. We have limited bandwidth. But if need be, we can sort of get to that level of execution as well.
So it's almost like a symbiotic relationship now between the investors and the promoters, where you're essentially not just piggybacking on the promoter, but you're actually helping in the growth.
Absolutely. It's like you get employees with capital coming into your business. That's almost the new private equity game.
Yeah. And moving on to Rajiv, just taking this a little forward on the consumer side, taking from the example of Burger King. I know you guys have made some big bets in the consumer space. How are you distinguishing between businesses which have a durable demand and those which are not just benefiting from a short-term momentum and growth?
No, thanks, Pritha, for that. I think one of the advantages of coming in a bit later, right, in the journey or the evolution of a business, at least helps you distinguish. So given we are late stage investors, right, something similar to what Pancham said, right, typically our check sizes at the minimum will be 50 to 75 million. The stage of the business itself that we typically come in needs to be at least a $50 million business in terms of revenue. Definitely like to see profits more often than not in that case. So at least that gives you one comfort that this is a model that has scaled to a certain level. Hopefully it's not a very city specific phenomena that is taking care. So some durability is there. Obviously the longevity of a consumer business or brand just helps, right? Build your conviction. And the other thing as a general trend that we've seen is, given we come in as late, more often than not, will not be the first institutional investor. So someone before us would have already been on the cap table, would have worked with the promoters, founders, management team, taken them to a certain scale and size, and then we take on the journey there. And that's where obviously our model is also right, pivoting towards doing a combination now of obviously minority and growth focused investments, was also now looking at control and buyouts. While we're still not focused on one versus the other, we're flexible in our approach. But that's where at least we distinguish. We do obviously get right inundated like many of our peers with businesses that are either scaling very fast. We've seen right post-COVID, a lot of scale up happened. During COVID, different businesses scaled up. But I think idea is to just right stay disciplined to what we feel are good businesses. And I think in addition to the management and good return on economics that Pancham mentioned, I think we also spend a lot of time trying to decipher the scalability potential of the business, right? How do you then take a $50-60 million business along with the management, right? Take it to 3-4 times the size. And I think that's where bulk of our work goes to distinguish, is this a fad or not, right? If I may use that word. So that's the way we at least disaggregate our focus and accordingly take some of our bets.
And you mentioned that you are not focused only on control deals and then you may choose to do minority or you may choose to do majority. What, other than of course the commercials involved with the promoter who may not want to give up control, are there investments where you let go of the investment because you think that this is something that you can make bigger if you were a majority investor rather than holding minority? How do you decide whether this should be a minority or a majority stake?
No, fair. So I think one, we are relatively early, more in the consumer sector journey within Chris Capital of doing buyouts. So idea is to then basically see most of the businesses depending upon the opportunity, right? So idea is we, I think, put enough and more criterias to evaluate a business, and at least I feel we're in the business of, right, eliminating opportunities rather than actually doing. So once you do enough of that, then I think we don't, as of now, put a criteria that if a business is in a good industry which is growing, if the management team is good, it's available hopefully at a decent and attractive price, then I think we don't put the additional burden that whether I'm owning 20% of this or 80, while the endeavor obviously is you want to own more of it. But I haven't seen us using that as a metric to say this investment makes sense for us versus not. I would imagine eventually we might get there, especially in areas where we'll see success of control happen, where our conviction increases. We might at least take those calls, but at least as of now, we haven't seen that to be a distinguishing factor.
Sure. And Srinivas, you've seen multiple cycles and have a strong middle market perspective. What are you seeing is the best risk-adjusted opportunities in India's middle market today?
So from a middle market perspective, or we are investors at the low end of the mid market. What we call mid market could be very different from what Pancham called mid market.
Sure.
Okay, given our fund size and the kind of focus that we have. Now, the fundamentals of investing don't change irrespective of, what we're looking at. The base minimum is still the same. A lot of the boxes need to get ticked. But there is one thing which is very different at the low end of the mid market compared to slightly larger companies is typically the second line is missing. So you have the founders. Founders have been running. Founders wear multiple hats. So that's where our job really starts. Can we potentially change the structure of the company? Because we are getting in, we're taking control. Ultimately, we need to sell this business. Now, if we need to sell this business, we need to be able to put it in a shape where somebody would want to buy it. Many a times, the acquirer to whom we want to sell is a global strategic. Now, if it's a global strategic, for them to parachute, a team into a mid-market company in India to run is not as great a thing that they look for. So we need to put that in place. Now, if I work backwards and see, okay, this is a business that we would want to do. Yes, it needs to have growth. It needs to be a clean business. It needs to be profitable, ROC, revenue growth. There needs to be a multiple arbitrage, all those things, right? But more importantly, will I be able to find people to run the business? Because we want the founders to progressively take a back seat in the businesses that we're investing. So what is a typical investment for us? Our typical investment for us is where the founder has been running the business for maybe 15, 20 years and has suddenly realized that he does not have inheritance, or in terms of he doesn't have somebody to pass the business on to. That's a very good situation for us. We like to get into those kind of situations where the companies are good, business is good, but there's no next line. There we need to build the next professional line. Then we need to see, okay, will we be able to find professionals in India who would be willing to come and run this business? That's where, sometimes it also defines the kind of companies we're looking at. In addition to that, we need to look at the themes that are taking place. Obviously, manufacturer-driven growth, which the government has been drumming up, and there's a lot of opportunity there. The second thing also is, China Plus One. That will also benefit a lot of the mid-market companies. So these are things that we're looking at. And the last one, obviously, is consumption, or basically lifestyle kind of things, which have been lacking in India in the past, but today,
with aspiration and growing income people want to have. You may call it consumer, you may call it whatever, but ultimately it is the spending power which is driving that. Now, that is where we are looking at certain sectors where we are finding these kind of opportunities where we can find people to parachute, at the same time deliver growth. So that could be healthcare, various segments of healthcare, and whether it is on the diagnostic side or it's on the provider side, various segments. We're seeing that in B2B tech. We're seeing that in, industrials as well. When I started off my career in private equity, we all wanted to do what the funds in Europe and US used to do as classical private equity. It was just impossible because founders would not let go. You can go and want to do, I remember in 99 we did a buyout deal, we bought 100% into a company. And then 5-6 years later, we sold that company back to the founder. So that was what used to happen. But today, that scenario is entirely changed. Founders are willing to let go. Because I think in a way, letting go of a business was a taboo in India even 15 years ago. That has changed. Many people here will recall Surfacey. And if you remember what happened in Surfacey or why it failed, is basically because founders don't let go, right? And classical private equity is no different. But today we are able to do it. And we are able to do it across. It's not just large firms. Large firms doing private equity, buying out is easier because you have, okay, when I say easier, please forgive me. I mean relatively easier. Nothing is easy. Okay, relatively easier because you probably have a semblance of a professional management. Yes, you may need to change it. But it's a business that is accustomed to being run by professionals because the business has grown, founders have brought in professionals. The kind of situations we get into, absolutely, there are people who are supposed to be second line, but more often than not, we probably go in and we need to change a lot of them. Or we need to bring in people who will be above them. That creates a lot of, organizational issues, but that's what we need to do. And that is possible today, which was not possible even 15 years ago. So in that sense, the markets have changed for the good.
So Srini, given you said that you come in at the lower end of the mid-market, how much importance does the fact that there is no next line of succession to this business play in your investment strategy? I mean, if you have to put into place a professional management team that is going to grow this business for your next for the next sale or for the next round of investment, how much time and effort goes into evaluating that before you actually decide whether this is a business worth investing in?
To put it simply, a lot. Now, that's where we are a little careful in terms of the situations we're getting into. We are not getting into situations where the founder is, just giving us the keys and walking away at the outset. So we want the founder to stay with us, help us grow the business, and gradually transition. And collectively we sell 3, 5, 6 years down the line, we collectively sell. That's the kind of situation we're looking at. And a lot of our time, because these are businesses which are already growing, there are global and local, macros that are helping the growth anyway. So from that point of view, we are getting into better situations. We are not getting into bankruptcy kind of situations. Now, having said that, getting in next line is always a challenge because, low end of mid-market, I can't get someone who's been running a large multinational company and put that person in the situation because that person will get frustrated, right? Money we can give, equity we can give, but the kind of people who are working there from a profile perspective will be very different to what that person is used to. And that is one challenge that we always see. The second challenge is reluctance of professionals who've actually done well for themselves to go into a situation where they need to roll up their sleeves and work. There's not that much supply in the market. So we have to ensure, even before we get in, as to how we are going to transition, what are the roles that we need to fix upfront. If we don't do it upfront, we'll fail. We did a buyout a couple of years ago where we knew we needed to hire a CEO. We got in, and then tried to hire a CEO. What we noticed is when you're trying to interview people to come in and join as a CEO in a business that we've already bought, more often than not, they only find the negatives. They're not willing to come in and commit themselves. So what we're trying to do now is when we are getting into a situation where we know that we need a CEO day one, we are getting people involved with us in the diligence. So they are buying into our strategy upfront. So that's a big learning for us, and that's something that we will do where we're getting into control kind of situations. But as I mentioned earlier, we would rather the founder continues with us, wears multiple hats, and we start filling in these roles progressively. And I think that's where we're finding a lot of acceptance in the market in terms of people. There are good people out there, no doubt. It is just that, they probably, Indian professionals are yet to start opening up and wanting to come into that situation. It could be that, they've probably made money recently, and therefore they're starting to think about their comforts, etc. And that's not happened, but I think it's a evolution thing, it'll happen.
It's interesting that you mentioned that, because this, I clearly recall, there are more and more investment opportunities now that are coming out of tier 2 and tier 3 cities, where private equities want to invest and want to put in place a professional team. But, because now you're talking about the Udaipurs and the Jaipurs and the, Kolkatas in India, finding the right talent in those locations, getting them to move there to run a business, as well as ensuring that they have the experience that is relevant for that size and scale, is becoming extremely important. And I think that's a good time to bring in you, Tarun, because there is now so much activity happening on the diligence front, where earlier at least people used to think of it as tick in the box, but now there are diligences on practically every stream in targets, including operational due diligences that are happening. What are the red flags that you think investors tend to underestimate that can lead to issues subsequently?
Sure. Hi. Good afternoon. Sorry, firstly, for being late. I wish I could say I'm Spider-Man and I was stopping a fraud in the friendly neighborhood, but I was just late. So apologies for that. I think we have an interesting perspective from buyout or majority, significant minority, large ticket size to mid-market. I think the advantage from our lens from diligence is today we are seeing diligence being included at very, very early deals, like we are talking about seed deals or sub 5 million deals to the largest transaction, which itself is a shift. Even from a clientele, from just growth private equity to mid-market, venture, family offices. So I think the encouraging part is that diligence is now kind of being consumed by multiple stakeholders or players in the industry. I think the slightly disappointing part is that while diligence or investigation has seen innovation, frauds are still following the 101 that has happened in the last 50 years. So still the common themes that we see are misreporting revenue or parking revenue in your parallel companies. I think less for funds, but many JVs in India, even in 2026, are suddenly realizing 18-24 months into their investment that they bought into something which wasn't as big as it looked like. So I think just over-reliance on audited financials is still a very big risk in India. I think related party transactions, unfortunately, with complex structures. One of the risks for rise of private credit, I feel eventually that would be seen is there are more and more innovations on holding structure, who's borrowing, where are you parking money. So I think there is a lack of complete understanding of what you are getting into, because typically you may be buying into a company, but the moment you get more access, you realize it's like a joint Indian family, and you're kind of stuck with it. I think the third risk, which I feel Indian investors tend to underestimate, is third-party risks. And actually, in an environment where we are seeing global turbulence, geopolitics play such a big role, tariffs and so on, suddenly sanction risks has become big. But many clients that we deal with don't even know the domicile of their third party. Or you look at chemical sector, most of their raw material is import. It's from China, but sometimes it's not from China, it's from other markets. They have no idea they're dealing with sanctioned entities, and the penalties are business disruptive. And I think lastly, in our experience, because India for so long has been called this IT hub, and now with this whole noise around AI, the reality is our cyber preparedness is one of the weakest among developed and emerging markets in terms of corporate cyber preparedness. We have very strong firewalls, but our response mechanism, our understanding and awareness from board levels to management levels around reaction to cyber events is very, very, I would say, basic. So these are some of the things which are coming out much more strongly on the domestic side. I think just what I'll add is part of our extended discussion on more Indian companies or funds are also doing cross-border. I think that's very encouraging. I mean, it's also bringing scale. We are seeing buyout companies use their Indian investments as a platform to invest overseas. But I think in the current environment, what's being overlooked is, like we know in India or historically also, that local or central politics or governments can have an influence. When it comes to international markets, we just assume governments are not as interested. But the level of influence of governments in Eastern Europe or Latin America is as high as it could have been in India. And I think a lot of our investors do not look at those aspects. They just look at the asset. They don't look at the environment. So those are some of the themes that we are coming across these days.
Okay. A question for you, Pancham and Rajiv both. How much of an importance do you give to forensic diligence these days? Because there is more and more demand for forensic diligence in the market. Is it now a given that a forensic diligence must be done on promoters of companies, especially which are, of course, heavily promoter driven? Or do you decide based on sector and, of course, the initial diligence input on tax and legal?
I think I can't emphasize more on the importance of forensic diligence right now. And we worked with Tarun, and he's been part of a journey where we've done a financial forensic and then a feedback loop, and actually passed on a transaction because of the feedback they came back with, right? And it is extremely imperative. It is our fiduciary. It's not our own capital that we sort of can play with. It is only prudent to check and recheck and double check, both reputationally, but more importantly now, not just reputation. Look, forensic is a lot of hear and say. Some disgruntled employee may be saying something about the founder, and you have to take that in a more balanced way. But I think financial forensic is also very critical now as things go by, especially a lot of businesses that go in distress. You need to sort of be acutely aware of how to look at them. Audited financial statements, as Tarun was saying, is not just the only sort of recuse you'll have. Oh, the Big Four audited something, and that's why we didn't need to do something, because audits are sample checks, right? Sample check is you're basing your assumption on normal distribution. There could be a left tail, there could be a right tail, right? It's only 67% of the answer, right? We can do very deep forensic checks. In fact, there have been times when we bought businesses in distress. We've recreated the P&L and balance sheet from bank statements, not trusting financials, right? and we've been surprised on the delta that came in versus audited financials, right? So I think as more businesses come into the private equity fold, open up to private equity or outside investing and investors coming in, forensics is only going to increase. It's a even more nuanced practice in the developed world, especially in the US. Here in India, you can call people and check randomly. In the US, you can't just call anybody without the founder's permission to do that, and it's a different method. It's not just hearsay, so you have to take it in balance, the views that come out in forensic checks, because you don't know who's saying what about you and who's angry at you on the street. But at the same time, the importance of deeper forensic and more data analytical forensics has multiplied, I would say.
So I completely agree. I think forensic is a must-have for us. I think more so in the last few years, right? We are trying to become better at it, right? With obviously partners such as Kroll, who we work with, because the idea is you get to the financial side later on, right? When you kind of vested in the transaction, you like the business, etc. But I think what we have realized, right, in our journey of the last 25, 26, it's a very relationship-oriented business, especially in our journey even till today. A large part of the business is being growth equity or minority partners with founders and management team. So getting that people side wrong, I think, is an absolute no-go for us. So therefore, trying to understand what are business practices, how do they go about it, and obviously it goes without saying there'll always be a few disgruntled employees. You'll need to uncover trends and not only take one word or one theme. So we will typically go in reasonable amount of detail, obviously through our partners, and more often than not, you will end up passing businesses and don't even go into the financial or any other kind of diligence, because that's a risk that is difficult for you to either align or box, or there are certain practices that you will find it very difficult to be comfortable with. And like Pancham rightly said, right, we are custodian of capital to our for LPs and investors, so that's like a basic hygiene for us now. Any new thing that comes in, I think you anyways do a quick one and then just go 1, 2, 3, 4 levels deep just to make sure, because beyond a point, I think your reputation then also starts becoming, right, equally aligned with the kind of investments and people that you end up partnering with. So yeah, can't put at least the amount of importance to that work stream, especially for, I think, all of us in the
Does
industry.
that become your starting point for diligence?
More often than not. Okay. More often than not.
So you would not even progress to a legal or a financial unless you cleared the level 1 forensic.
Yeah, absolutely.
Okay, and Srinivas, does that change for you at the lower mid market, or do you
Not at all, not at all. Maybe when I started my career in private equity, we did not spend as much or did not pay as much attention to forensics and integrity checks, etc. But in the last 5-10 years, it's become important for us as well. All our deals, forensic is a compulsory thing. Whether we do it at the beginning or somewhere during the process or simultaneously, it is definitely done. And it is a go, no-go decision. There's no scope for gray in that. And in addition to that, when we are hiring people, because we have to hire a lot of people to run these businesses, we do integrity checks on all of them. And you'll be surprised the kind of things that come up. We were trying to hire a CFO for a company. I don't want to take any names. The person comes from a multinational background. He's claimed to work for a multinational, which is actually a JV between two multinationals. And the company is audited by a Big Four. He gave us references of people, the candidate gave us references of names of partners that we should speak to. And, I just checked with another partner from the same Big Four about the partners that I'm supposed to speak to. And I'm told, no, there are no such partners.
Wow.
Okay, now, so, you know, there are all kinds of things that come up. This is such a, and it just turns out the partner that I spoke to, he said, by the way, I'm the signing partner for the company that you're referring to.
Wow.
And I don't even know this person. So, so that's what makes it very important for us because, we are trusting these people as, Rajiv mentioned, we can't go wrong on this because that gets aligned to us and tomorrow somebody else will, kind of see that as, or it'll be a, dag on us, as you would
Sure.
say in Hindi.
Sure. And Tarun, how many times have you seen private equity investors actually come to you post-investment where they've realized that, oh, we may have made an error in judgment regarding a person who is the promoter of the company, and where do you go from there?
Sure, so that's a tricky one. Clients, I mean, I think post-investment, they typically don't come unless they feel it's the last straw. You will try to fight it out. I mean,
Redeem the
you'll bet your chances on I mean, how much is it salvageable? Could you bring in a new management? Could you, because you're in it, and especially with the ticket sizes that we see in India today, I mean, if you've realized it too late, I don't think exit is the option there. We have got involved in situations, where there has been wrongdoing or frauds, which is genuine misconduct, which needs more, I would say, investigative situations. I think post-investment, two aspects. One, we do get called where you start sensing something is not right. See, because after you've invested, I think the leverage slightly changes, right? You're all in. It's like you're in
balance
poker.
of power has moved.
Yeah. So I think you'd also, like Pancham said, lot of times, the funds have their own network. You're so invested. You know people. You start hearing things, but that's not good enough for you to go to a promoter and confront. You want to validate with either authentic information from someone like us or get some evidence. So that's where we step in. It's like any whistleblower allegation also, not every allegation is right, like 6 out of 10 whistleblower allegations do not hold merit. So I think our role there is to either give them the confidence that this is not as big as it's made out, or this is genuinely serious, and that aids them to then take action, confront promoters, bring in their own CFO, depending on the nature of issue. But I think there the first step is resolution, solution, salvaging value of your investment before, like in an asset like Byju's, I think people would have gotten involved at very different stages of its life cycle. So I think our role there is very much to give as much factual information as we can. I think, however, I mean, just the good thing in the industry is, I mean, I've been at Kroll 10 years, generally 6 or 7 deals out of every 10 that we diligence largely pass the muster. So it's not that, what you're getting is generally bad and so on. So I think, I mean, many times entrepreneurs or founders get the heat of it. I think largely on an average, it's good. The other shift we have seen, and I'm glad to hear that as well, is earlier diligence was very much a term sheet linked thing. Okay, we are about to sign a term sheet, let's get a diligence. I think today, both from a time and energy perspective, because by the time you come to term sheet, you've spent so much time, but funds are saying, I need to know very early on if it's a go, no go, from a reputation, conduct point of view. I very honestly feel it also takes away the FOMO in the industry, because if you very early this is not for me, then no matter how the other chatter and valuations are going on, you have your information to stay out of it. So I think that's a positive trend. And I think the other thing we are seeing is, because forensic in India is fairly loosely Daya types of thing. I think what we are seeing is we are getting involved actually as soon as an investment happens, especially in majority or buyout, first 100-day smell test. Because no matter how much diligence you do before investing, you have access to VDR and all. If most things are tying, you're in a deal making mode. But once you are in, you have access to ERP, you have access to people. The best way to get intelligence or information is people, no? And then marry it with data. So we are sitting in companies, we are doing walkthroughs with finance, with procurement, with supply chain, and then looking at data, looking at policies, and you can see if they're talking to each other or not. And the intention there is that information goes to funds and they can start correcting it today rather than realizing a year later that the CFO left a big hole. So I think, the industry is definitely thinking about how to use forensics or investigation. And I think, again, broader AI, but data science is becoming a very central part of even forensic and investigation. The more data we get, the more we are able to throw at you patterns. So that only is possible post investment. But in all honesty, I've also seen investments where you find stuff and deals happen. So, but that's on them. And that's the nature of any industry, competitive industry.
I guess it's a matter of deciding with how much risk is involved in what has been found and how much it can be de-risked.
Yeah, also, India is a lot about valuations. I'm now seeing reports in media saying IDFC has fallen by 20%. It's now a great bargain. The event is irrelevant, right? So that's the market we are in.
Yeah. And now that you mentioned, the way the stocks are behaving, public markets in India have been doing extremely well over the last, I think, almost more than a year now, I would think, and been either growing or stable. How much has that impacted how you look at investments, targets, whether you are able to meet valuation demands, I would say, from promoters? And I'm sure each of you will have your piece to say on this. So why don't we start with you, Pancham?
Look, I think markets, in fact, if anything, last 6-8 months have been anything but good. Especially not my portfolio, at least, my personal portfolio, not the firm's. But overall, the last 5 years have been stupendous for the Indian public markets, right? And two big things have happened, given how deep the markets have become. There is massive depth in the public markets in India, probably the deepest markets globally after the US, right? With the domestic capital that's found its way into the public markets, it's reduced the swings that we used to see, what used to be Black Monday, Black Friday, those kind of terminologies have sort of, you don't hear those as often as what you used to 5 years back, right? It's driven by sort of a floor that domestic capital has created for valuations and for stocks. The other important thing that's happened is with this depth, there has been an opportunity for a lot of control positions to be offloaded in the public markets, right? 6-7 years back, if you had to sell down 70-80% stake in the public markets, you wouldn't underwrite that as an exit thesis. You would probably sell to another private equity player or a strategic. But now you can actually sort of list a little earlier in your sort of hold period, sell down a little bit in a pre-IPO, sell down a little bit at IPO, and then sort of hold on for, if you get locked in, you get locked in as promoters, but then start selling down in the public markets over a course of 12 to 18 to 20 months, depending on how much stake you have to offload, right? So that avenue of exit that the public markets have created, even for control deals, what I call strangely enough was happening till some time back was there was a minority premium and a control discount, which is quite contrary to what you would hear that there should be a control premium. And the reason that minority premium came in is because deals were getting priced at pre-IPO multiples and anchored around where the public markets are. If you are a minority deal, it's definitely going public. You are an N+1 shareholder in a cap table. In control deals, often you cannot underwrite that thesis that you can go public. So you could get a discount oftentimes, right? That discount be taken public. So we should know that there is no IPO happening, and so if the multiples are 25 times EBITDA in the public markets, they would be 18 times EBITDA in the private markets, right? That is beginning to change, right? And as that changes and markets become deeper and more structured at different levels, the control opportunity is going to compound from here, because there is a big exit opportunity for control investments in the public markets now.
No, I think just to build on that, right, completely echo the thought. I think one of the reasons I think we're seeing a large part of the investments going through control is the same reason that exit option, which used to be maybe a one-off option in the form of an IPO, is more often than not a base case. Irrespective of the stake, right, we've seen very, very large stakes, right, with some of our larger global peers as well, where people with 60-70% are able to offload, right, in a 2.5 year period, which gives us the comfort, right, that exit options will be there. All of us have seen, right, the SIP journey that, right, all of us have been part of, right, as the investing community across all mutual funds have also helped in that education and such, right, just creating more awareness and depth. And I think that continues to be the case through and through, as a very good fillip for doing more control deals, seeing exits, new businesses, right, to the extent, right, that a lot of companies, right, that would look to flip structures in Singapore and other places are looking to flip back, right, and list in India as well, just because the depth. And I think over and above, right, that on average the market in India loves growth, and hopefully you'll get a better valuation. But I think fundamental change, which is only going to go hopefully in the right direction, barring the current, right, last 6-12 months of noise, which one way or the other is expected to continue. But hopefully if you take a 5-10 year view, which most of us at the least do with most of our portfolio, I think things are just going in the right direction. Yeah.
So from the way we look at it in the last 1.5 to 2 years, one of the things that we've started looking at as an exit option for our portfolio companies is listing. If you had asked me 2 years ago, I would have said no. We are looking at only M&A exits, whether it's to a strategic or a financial sponsor. So we are looking at that. So that's the positive of it. From the negative of what's happening in the market, it has reduced the deal flow for us for sure. There are a lot of companies who, I'm specifically talking at the low end of mid-market, who should ideally not get listed, are getting listed, number one. Number two, a lot of the founders of those companies are getting swayed by what they're being told by the bankers. They're not exactly very sophisticated, and they're being given to understand that listing is an exit for the founders. And I just can't understand that, because once it gets listed, all of us know how difficult it is to do an M&A, and the takeover code doesn't make it easy, right? So it's going to be very difficult for those founders, but they are doing that. So what I realized is that there's no point in counting those as our deals anyway. If a founder is getting swayed by listing and wants to go for listing, that's definitely not a founder for us, because we will find it tough to sell that business 3 years, 5 years down the line, because that founder still has listing in his or her mind, right? So it's going to be difficult. So we clearly want to focus only on founders who are willing to sell their businesses along with us. And one of the tests is whether they give us a drag or not. If a founder refuses to give us a drag, we don't do a deal. Whether we can exercise a drag, that's a different story altogether, right? So even from a mindset perspective, those are founders that one needs to be careful about, so we stay away. So that has reduced our deal flow. So in that sense, yes, public markets are competition for us. There's absolutely no way we can pay those kind of valuations. Some of these businesses don't even deserve it, right? So from that point of view, one needs to be a little more, or rather we need to look deeper to find our deals.
Sure. And Raju, just keeping all of this in mind and adding to it the ever-changing geopolitical situation in the world, where every day is a new day. Tariffs can change the next morning, and you won't have any inkling that it is going to happen. How much of a how much of a wait and watch game needs to be played when you're making an investment decision regarding a particular sector that you think can get impacted?
No, I think fair point. I think last 12, 24 months we've seen, I think, uncertainty and therefore volatility only increase. And different sectors, right, depending upon the exposure, right, how much are you export oriented, what's the regulatory pressure, dictates a lot of that. But I think incrementally the way we're looking, right, idea is to stay away from, right, uncertainty as much as possible. So anyways, bulk of what we do is we largely back Indian entrepreneurs and founders, right? And the only exception is the enterprise tech segment because that's a global market. So large part of the portfolio for us anyways is India, but obviously there also, right, there'll be financial services as a segment, which obviously is regulatory driven. When you talk about certain pockets of consumer, you'll have to see, but largely that's insulated to a large extent. But I think increasingly, one of the key risks, right, in our parameters of evaluation is what level of regulatory exposure are you getting yourself into? And I think more often than not, we would, right, historically assign some kind of probability and then balance it out. Whereas some of these things at least are taken with a much sharper view that if this is going beyond a certain percentage of business, etc., you calibrate it because more often than not in a 5-6 year period of our holding, it's bound to happen in impact. So much more scrutiny and ideas to maybe minimize the share, which maybe 3 years back, if you would ask, we'll be a bit more relaxed about it.
And Panchan, specifically in the life sciences and pharma space, it's been fairly volatile given the tariff situation. Does that change the investment strategy for you for those particular sectors? And also, how are you helping your current portfolio sort of try and mitigate what is happening?
Yeah. No, I think this has been something we've done chapter and verse on. We like buying India cost dollar revenue assets, generally hedges the dollar fund, dollar short position that we take. And tariffs has a big impact, if anything. But fortunately, the way we have constructed our sort of investing modus operandi is we try to be the lowest cost manufacturer of things, right? And get into segments that are at the sort of not always at the forefront of things, right? By the nuts and bearings of things, right? For example, generics, right? India today, just to give you some stats, 60% of what US imports as pharmaceuticals is coming from India in volume terms, 60. In value terms, that falls down to almost 13%, right? So India is actually helping reduce the healthcare costs in the US, right? 87% of the value that the US is importing is coming from mostly 3 countries, Switzerland, Ireland, and Singapore, right? Singapore is a routing mechanism for a lot of biotech that they import. And that 87% or 80% of the value that the US is importing is very small in volume terms, right? So India's position in the US in the life sciences space is very, very critical. Now, if you slap tariffs on a Panadol that's coming out of India, do you think Indian guys will be able to sell in the US? They won't. The margin profiles are not that robust, right? And what that may do is a Walgreens or a CVS or even a Walmart's in the US will not have Panadol as stock, right? So the displacement of India as a big supply source is very, very hard. And if you see, generics have been exempted from tariffs, right? So the sectors we play in, fortunately, or for the way we've constructed our thesis around it is to be the lowest cost manufacturer of things. We've not been impacted, although we had a think and a rethink and a think and a rethink around how do we sort of invest in the space. These are sort of, I would say, noises and disturbances that come. You should do your analysis and be very cognizant of what may happen next. It's unpredictable, but at the same time, if the core moat of the business is built around something that is defining industry structure, it's unlikely to shake up that easily.
Okay. And while we're on that subject, you know, there is a study that says secondaries are surging globally. In 2026, it's expected that it will be in excess of 260 billion US. So investments are more of secondaries, less of primaries. Do you think this is because of exit strategies that are coming out of investments that have happened in the previous round of investments at a lower mid-market level, or do you think this is just a global trend?
Can take the first crack at that one, but look, I think a lot of it is also being driven by the private equity capital available to do secondaries, right? Globally now, private equity is one of the larger sources of all capital, right? Endowments, insurance companies, etc., they have all sort of almost doubled their allocation to alternates in the last 10 to 15 years, right? And as private equity grows, more control transactions happen. More family businesses become open to sort of selling down or either selling down their positions or exiting their businesses. Just look at India itself, right? How many founders are now willing or open to sell their businesses to PE, right? Versus what they were 10 years back, right? That money then finds its way into the public market through a family office or, you know, some of the other sort of a newer phenomenon that we've seen. So it's a function of returns that are generated in the sector, finding its way back into the market as more private equity capital, more dry powder available, more control transactions happening, and more founders willing to exit their businesses, and then those private equity funds also churning their stake out at 2x, 3x of the amount that they invested. So this is only going to grow. As private equity grows, it grows with that.
Any thoughts on that?
So secondaries is not new. The first time I did secondary was I did 3 secondaries in 2007. So it's been around, but it's taken a long time to come to this position. Typically, the challenge in secondaries is that the secondary investors want a discount, right? Now, in a market such as this, convincing any of our existing LPs to take a haircut is not going to be easy. They're not going to do that. So it's only someone who's desperate to get out for whatever reason. They will go for it, or you know, the fund is coming to an end and you're unable to exit, and therefore you will do a secondary. Neither of those situations are, you know, realistic at this point in time, because, you know, the capital markets are buoyant, you can potentially do that, you can exit. So why would somebody want to go for secondaries? It just has to be someone desperate to get out. In a situation like that, you would get a discount. Otherwise, the large capital that is out there for secondaries today could potentially lead to reduction in the discounts that you're seeing on the NAV. And so that may be a good play. If that happens, I as a GP will go and offer it to my LPs, because, you know, that helps me get them into my next fund. You know, they get liquidity, they can start committing to my next fund. So let's see how it plays out. I'm on the fence at this point in time on that.
Okay. And Rajiv, we're seeing more and more, at least in my experience, we're seeing it take longer to go from term sheet to deal closure in the last couple of years, with intermittent times when you have value renegotiations because either the promoters are not delivering the numbers promised, or the value proposition has changed. But it almost seems to be happening, of course, not just in consumer, but across all sectors. And any thoughts on why that is?
No, so I think specific to consumer, the last, I would say, 8 to 12 quarters, right? You had a decent amount of ups and downs, right? More downs than ups. With one was macro, certain segments, right? Especially QSR across the board was not really performing. You had commodity-related pressures. So on average, you're right. The biggest thing, right, when all of us are doing our due diligence between, right, the term sheet and when you do the work, let's say for a couple of months, if performance during that period starts faltering, right, or going a bit amiss, you end up, right, trying to decipher what's happening and trying to see if it's a one-off or actually a trend. And then you come back, right, to the negotiation table. And I think rightly so, if there is slightly bit of outperformance, the founders also try to do the same. But on average, I think that is the reason where it's taking longer to do deals. But I think also more importantly, at least at late stage, we're also putting a bit more time on diligence itself, right? For example, we spoke of forensic as one which ends up being a precursor, but in addition to the standard commercial diligence, operational diligence also ends up being, right, something at least in late stage is a relevant point. But I think the other thing that I've also seen is, I think on the legal documentation itself, right, few years back versus now, some of this might be coming from, I think, lawyers at both ends, but also expectations on what used to be a bit more standard set of terms few years back versus now. There's also a bit of dilution there that you see, and that's a function of how excited that opportunity is, the number of people, competitive dynamics. But I think a combination of all of these things, especially the performance of the business, right, slowing a bit relative to what you thought, is leading to it, right? Even a couple of our deals in the last, and especially on average, it takes a bit longer to close a buyout deal. Just the rigor of doing something, and like Pancham said, right, with the minority beyond a point, while you also do your diligence, it's a sample check, right? But at the end of the day, you also rely that if there are a few things amiss, you have a founder or set of founders to rely on. In a control situation, you have to take that role, so hence you go a bit more extra mile on everything that you're regularly doing. So definitely that additional couple of months I've seen a bit more in control versus minority. But on average, those are the few things that we have seen in the last, call it 2 years, that has led to a bit more time leading to closing a transaction.
Diving a little bit deeper into what Rajiv is saying, Tarun, how much more have you seen a change in the way that private equity investors are doing diligences? Are they spending longer on their diligence than they ordinarily would? And is there a deeper diligence now that is being done than ever before?
Sure. So I think just I'll pick on the buyout. I think one of the things we are also seeing is a lot more scrutiny on the management, because by default the intention is not to come in and change the management. The intention is, how incentivized are they to continue deliver. I think it varies from sector to sector. Some, more technical or life sciences and so on. The kind of IP that's there to consumer, which is very different. So, and we have seen funds go really deep, like we're talking about 10, 12 of their KMPs being scrutinized like they were the promoters, because in effect they are running the show. So I think that's also something which leads to buyouts taking a bit more time. But I think couple of shifts. I think what's happened is, 15 years of great run in terms of private capital coming into India. So the questions that we today get on diligence are very different. So 15 years back, very macro, India, bribery, corruption, promoters' behavior. I think today, given the amount of capital has come in, some of those are like there's an acceptable level. I wouldn't say all of that has gone out, but there's an understanding on how much there is and how much you can tolerate and live with. So we are now becoming much more of strategic intelligence than due diligence, because I also feel information access in India has also improved, independent of AI again. Quality of financial information on MCA, litigation information and all of that is much better today. So by the time somebody comes to me, they have a fair sense of,
They've done slight diligence.
they've done their bit of very initial diligence. So the questions they're asking us are far more, risk and impact, and not, I would say, diligence. So it's not scrutiny, it is how deep could you go. So we are spending a lot more time on ground now rather than on desktop. So we're spending time on sites. If you take a manufacturing, we are spending a lot more time around facilities, around warehouses, even consumer. We are spending a lot more time at supply chain. If it's healthcare, like hospitals have seen a lot of activity in India. We're actually spending time with doctors, specialists. We are spending a lot more time at grassroots level to understand business practices. Because there is, this whole, India still deals a lot in cash. So lot of the questions we are hearing today comes back to revenue, because valuation and everything is eventually linked to it. So I think we are seeing our role itself move to strategic intelligence. I think geopolitics, impact of geopolitics into it is coming very actively. Like we have the amount of diligence we do in and around global elections now is increased suddenly. Like even Bangladesh, you're trying to understand with this government coming in for India, looking at politics and security, would China get more involved, or would Japan be active investor in the new system? Because all of that influences parts of your business. So I think geopolitics is becoming very central into our diligence process, also because India is getting more cross-border. So I think that's a shift we are seeing. And I think the third change that we are noticing in the diligence process is it's also becoming far more partnership based. So earlier our diligence used to be 2 weeks, 3 weeks, report de do, and then I'm presenting far more to ICs today directly. And I think it's a combination of funds are also de-risking. So my sense is investment team do not have the same kind of control on diligence than that they used to have. Part of it is because of some of the accidents that happened, but funds have also invested a lot in their own compliance. So the fund compliance teams are far more, they have more head count today. So why we like it, the more information we get from funds before we start, the more thorough I would say is our diligence. If you're just starting on a blank piece of paper, not knowing what's valuable to you, you will come with more generic information. So we are spending a lot more time with the client before we even start the diligence. The scope of work is not a standard scope of work. It's very much, I would say, designed to fit that particular asset. And then there's we have to do far more active updates. It's not one report. Lot of verbal and interim updates, which actually makes the end work product much better because it's collaborative. That I've definitely seen as a shift.
Okay, if I can ask all of you to just crystal ball gaze for a minute before we throw this open to the audience for questions. What's your outlook on private equity for 2026? Mike.
I think, look, it's been great last 3 years for the private equity. I think what is sort of, what I would be very interested in I would say see play out is how the public markets behave for exits in the next 12 months. We're hoping that some sort of robustness comes back because, a lot of guys made a lot of hay when the sun was shining on the public markets. I think they've been a little more muted in the last 6 months, but generally think that it's a great buying opportunity at different levels in the public markets right now, and more capital finds its way. But that will be an interesting sort of thing to see. And the second thing that's likely to happen is a lot of deal flow will start coming back to private equity, especially for the larger guys, because what was going public was generally an asset with 300, 400 crores of EBITDA at least at the minimum. That starts finding its way back into the private equity fold as sort of multiples don't hold as they were holding up for the last 2-3 years. So that's a big opportunity for private equity, I would say.
As lawyers, I certainly hope so.
So difficult to gauge from a 1 year. Obviously, long term, it's a good space to be in, right? Another reason to also justify your existence. But I would say, right, the whole scrutiny of the public market is done in the right way, right? Where profitability, economic focus is there, right? A whole bunch of stuff, right? Especially on the consumer side, we've seen, right, has not really held up to its end of the bargain, and hence post-listing performance has not been great.
So I would say some of that, right? Definitely we'll see, and we're already seeing at least early signs of deal flow just being reasonably good for this calendar year. And hoping one is deal flow, but also I think good quality companies, right? Because pricing for India more often than not ends up being reasonably punchy. But if economics are there to support, it's easier to take that call.
You know, I guess this statement goes for all of us who are in this industry. We have to be optimistic. Otherwise, we wouldn't be here. Okay, that's the first thing. But having said, I think the way to look at this industry would be more from a fund cycle perspective rather than a year-to-year perspective. And from a fund cycle perspective, I think I'm very bullish about what's happening. This year, I mean, it really depends. For example, I think I told you earlier, 25 was a very difficult year for us. We lost a lot of deals. But we did a lot of work with our portfolio companies. We acquired companies for our portfolio companies. This year, again, the deal flow looks fantastic, right? And there are still a lot of acquisition opportunities for portfolio companies. So from that perspective, I'm seeing a lot of activity, and hopefully it'll all materialize. Fingers crossed. It is going to be a good run.
But now that you mentioned portfolio companies, a lot of private equities are creating platforms with bolt-ons and tuck-ins, you know, with the hopes that the holding company is going to go ultimately public. Is that also a strategy that you are employing?
100%. One of our core linchpins is what we call buy and build. We've done over 40 bolt-ons for portfolio companies over the last 10 years, and we don't restrict ourselves to any geography. We can buy geographical presence for our businesses, so it could be something in Netherlands, something in Germany, something in the US. We bought businesses out of bankruptcy processes in Long Island in the US. So it's a very, very key part of our strategy, and bolt-ons will continue to be a driving force of adding growth to our businesses.
And is that focused to pharma, healthcare, specific sectors, or are you doing
Across
that
sectors.
across?
So we do it in pharma, we do it in tech, we do it in industrials as well. And it just helps add geography to the existing portfolio company. And you can then position the business as a multi-geographical sort of platform.
Sorry,
Yeah,
yes,
I mean, if I can add, and I mean, that would have been my trend. So we are, every other deal that we are doing is a bolt-on sectors, healthcare, industrials, and then infra is increasingly predominantly platform transactions. That's where we are seeing most activity. So, I mean, for me, or, you know, it's only 2 months, but we are seeing huge potential on larger deals, buyouts, bolt-ons, and then we are seeing this crazy money flowing into AI, and it's like, I mean, from a predictive point of view, it's people are just taking bets that 1 out of my 50 will work out. So there is a lot of pain that
You
to
only
the
need
investors.
one. You only need 1 out of the 50.
Yeah, you need, but the 49, you have to be the one which has that one.
Yes.
So we see a lot of pain coming into that segment while there would be, you know, home runs.
Sure. So we can pass this on to the
You can go for
audience for any
questions.
questions.
Yeah. Any questions from the audience are welcome.
Yeah, so I'll probably take the first tab. So this is to Tarun. So I would like you to kind of double click on what you kind of alluded to on the private credit front, right? So one, in terms of the related party transactions, so you kind of hinted that there's some trouble to come. Is that what you're trying to say?
No, so, okay, so related party is something which I would say is still very prevalent in India. Not that related party transactions are wrong. I mean, the entire, even the whole listed spaces with related party transaction, it's the opaqueness around the holding structures and where the assets are built. And typically when we see distress, because we do a lot of work on distress, that's where we see that assets have been moved out of structures without even investors knowing. So I think related party is an independent view. I think on private credit, I mean, it's interesting space for us because large part of private credit is still special situations or distress. I think you are getting performing credit as well, but you know, if you're dealing in 18 to 25% yield, by default, you know, something is not right. So when we are being brought in, the investor already knows I'm getting into a company which has large litigations, potential bankruptcy, an ED CBI action. So they are not coming to us for that insight. They are coming to us for again, I'm using the word strategic insights. They want to know outcomes. So if I'm going to take a 3-4 years experience with an IRR of 24-25%, what is the likelihood of this asset going down in those 4 years? How much is the promoter going to spend their own equity into this? How badly are they leveraged in the unsecured market? So a lot of Indian promoters still have exposure to hundi market. So they want to know, and you will not default to them, you may default to a bank. So they want to know how poorly are they set up in that. So the questions are far more, what if, rather than can you tell us more about them. I think private credit is booming. I mean, we have now seen $1 billion check being cut on private credit. So that market is here to stay. I mean, they may know better whether it's eating into their pie or aiding it, but definitely we are seeing a lot more activity in that space.
Sure. In fact, the panel should talk about the space, how big it's become compared to even private equity. So what is your take on how private credit has kind of overtaken, I would say, private equity?
I'm very happy about it because it gives us options, funding options for our acquisitions. I can fund my acquisition without diluting. Why just that? And even now banks can also fund acquisitions for us. So in that sense, credit market growth is very good. Globally as well, if you look at credit markets, they are 20 times, 30 times sizes of equity markets. So in that sense, it's good development, if you ask me. And it also gives investors a diversification in terms of their own assets. Otherwise, there was hardly any diversification for the Indian investors. You put your money into a FD, or you go and buy let's say a mutual fund, or you put it into capital markets, right? So that depth variation is developing, which is good.
So definitely, right? At least, especially the shift towards buyouts, and I think globally all buyouts are largely leveraged, right? That's largely, broadly, majority of private equity money, right? Markets like US, Europe is dictated by, right, how, and from the depth of the debt markets there, we are seeing very early signs, right? And like Shini rightly said, some of these only help, right? Because now banks can do this. There's also some recent change in ECB norms, right? And all those things are at least moving in the right direction. Obviously, you have to be careful around, right? How do you structure a capital structure from a transaction, and obviously don't get too much carried away. But I think all in all, I think that just opens the market, right, from an avenue perspective. And if you do that balance, right, I think it's a move in the right direction, which was ought to happen. Yeah.
Just to add to that, if you remember, just a few years ago, private credit was largely happening at 18 and 21%. And a good part of it was going into real estate. If that market expands, you will have private credit available across the spectrum. You can start from low teens or even 10, 11%. We are getting offers of 10, 11% for some of our portfolio companies now, which is good.
Right. So, firstly, thanks a lot for this. I'm Anish, and you stole a few of my questions, but that's fantastic. So, two questions. So since we've been talking about controlled situations, there's always, there's a goal set, and, you want to create a delicate balance between diluting the promoter too much versus just enough. How do you kind of decide on reaching out to that balance? Because you don't really want them to be disincentivized to continue pushing the company. Obviously, earnouts is one of those, but there'll be different mechanisms. So I think that's question one. Question two, in terms of, like we mentioned about private credit, right? So how open are you, and at what point do you look at? And, as LPs, we also do generally look at Axis Bank in terms of if it's a P or a growth fund. Fundamentally, how are you looking at optimizing the capital stack right at the time when you're deciding to invest? So yeah.
So the first question on how do we incentivize founders and management teams in a control deal, I think it's a very good question, right? It's the gray area, I would say, in any control transaction uh, that you have to be very careful of how much secondary is the founder going in with, going out with, right? And you know how satiated is he going to be, how much fire in the belly is going to be left around, and which is why the institutional backup comes in, right? Where you start professionalizing management teams and sort of building a backup to the founder, right? So what I would say is there are two methods to incentivize, right? First, have a simple philosophy that let's say you buy 60-70% stake in a company, the balance 30-40% should be at least worth the 60-70% that he encashed today, right? That's one way to sort of build a plan towards, right? That's a very big incentive for founders. The second is treat them separately. A same guy running the business and also having a minority stake in the business, the shareholding role is different, the employee role is different. So you have to think about an ESOP package from a CEO's role perspective, or even for the new management that's coming in. We typically have anywhere between 3-7% of the company, depending on kind of business, just reserved as ESOPs. That sort of are at our cost of entry typically, and there is a set pattern around how you sort of vest them, but that's the other way of incentivizing management teams. And generally we make money, you make money is the philosophy. And oftentimes we also have upside share structures, right? That if I get to a certain IRR and MOIC threshold, we are happy to share a certain amount of upside with founder partners or CEOs, depending on what kind of a deal construct you've stitched up at the beginning of the deal, right? So these are generally sort of methods of incentivizing management teams and founders to continue despite sort of not having control. But then again, control may not necessarily always mean that they've done a large secondary, right? It could be in a lot of primary into the business to buy something else, right? On private credit, I think look, there are two parts to private credit, and private credit as an alternate to private equity is a separate box, and a credit available to do buyouts is a different box. That's a catalyst too. That doesn't compete with us. In fact, we do it very often, especially when we have dollar cash flows and ability to pull cash from dollar to dollar. We can leverage in different geographies and sort of at much lower rates, right? What typically people call leverage buyouts, although it's not largely leverage funded. Leverage is the minority there. But we do that very often, and it's a great return juicing mechanism, something that has driven US returns to what I call first quartile, 20% plus dollar returns in the US. It's largely leverage. What the capital markets have been doing for Indian GPs in the last 10 years, leverage has been doing that for US GPs for over a decade now, right? So it's a great added tool that you have, and it's finding its way in India, and you will see a lot more leverage buyouts come through in India as the market evolves and deepens. Private credit is a separate pool of capital as alternate capital available to typically what was historically more sort of special sits, as we used to call it, where just equity or just debt is not available cheap enough. Equity is going to wipe the existing equity out, and that's where special sits of private credit stepped in typically, right? Where it's a part fixed return coupon plus a warrant coming with that, right? To compensate for the 25% that you're not making versus the 15% that the private coupon will give you. That business has sort of oscillated, I think, in India for several years. What was special sits? There has been mixed performance, I would say. Some have done very well, some haven't. And that market is probably, as Srinivas was saying, in the US, probably twice the size of the private equity market. And that market will take hold at some point in time. India will mirror what the developed markets have seen in structure and depth as time goes by. So that's here to stay.
Any other questions? This is to Tarun. Tarun, you mentioned that forensic is becoming, even early, even seed, Series A deals are doing this. So I wanted to know, you mentioned 6, 7 out of 10 are good, right? But out of the transacted universe, what percentage of deals engage a forensic DD? That's question number 1.
I think in value, that percentage would be large because most large transactions end up having forensic and diligence. So I'm not sure if that's the right metrics. In volume, I would say maybe 40-50% go through it. There's still a large universe. See, I mean, also very early stage is friends and family investment format. So you get introduced to founders and so on. I think it's after that very first seed, the first time you're going to an institutional. So beyond angel is when somebody thinks of, diligence. I think one thing we are seeing is our kind of diligence is replacing vendor diligence. I mean, it's a technical term, but a lot of time companies who raise money are going with the banker with their diligence on their own. That's like the biggest conflict of interest. Like you're saying, I have diligence myself, I look good. So I think we are replacing vendor diligence at very early stage. And by the time you go to Series B, Series C, it's common. I think clearly there's a lot of piggybacking on the larger investor and their call. But I think one of the shifts we are seeing is in the past, an investor used to say, okay, fund A had already invested in this, so it would be a good company. I think there the industry hasn't done itself too much favor. So now, I mean, it helps us. Just because another institutional investor has invested doesn't mean the new fund would not do its diligence.
Absolutely. Second question is, in the early stages, how would, let's say, the funds or the transaction fund the forensic DD costs? Because at least in the LDD, financial DD, etc., we can move it back to the company. But this is a little bit touchy topic, right? Like no company will want to know I'm doing a forensic on you and then you can't put it in the term sheet, then it'll alert the company.
So I think it's changing. I mean, I think more companies which are going into fundraising or private equity firstly know that there will be diligence. They may not like it for the ego of it. I think DPDP will make it even more visible because we are also advising our clients that please let the founders know that they will be diligenced. You don't need to tell them Kroll will do it. You don't need to tell them how deep will they go because we don't ask for any information. But I don't think it's a surprise today. I mean, Pancham mentioned, US, you cannot do discrete intelligence gathering. And actually you get far more reliable information by saying, I'm Kroll, I'm representing a fund which is seriously looking at investing. Can you tell me about it? That won't happen in India. But I think general acceptance is there. I think in our model, if the investee starts funding the diligence, that's a huge red flag. So we would encourage funds who have to use us need to have, I would say, the pockets or the willingness to think of this as, I mean, if you think of it as an expense, it won't work. You have to think of it as part of your investment cost. I think there is more willingness. So I think the industry is evolving.
For a fund of our size, it's a big expense, but we take it ourselves. We don't pass that on to the founders. And yes, corporate finance advisors will definitely let the company know that, or the founders know that there will be a forensic. But it's a tick box now, for sure.
We have one question.
Yeah, my question is related to the money flow. So as the interest rates are coming down, so you expect this year and next year there will be a huge flow of private equity capital to India?
I don't, to be honest with you, I've been hearing this theory for last 30 years. Every time global interest rates go down, we get excited that there'll be a lot of money coming in. But it's not played out like that, to be honest with you, if you can actually go and see. It's good metric. but then I think it's the fundamental performance that matters a lot. The next thing that global investors are worried about is the rupee depreciation. So that's when they look at dollar returns, whether India has delivered or not. For a long time, India had not delivered. But in the last maybe 5-10 years, that scenario has changed. And hopefully all of these factors will work. And what you said, you know, aapke muh mein ghee shakkar.
Thank you.
Thank you so much. Yeah.
Hold for the mic.
Sorry. So yesterday I was with our economist from Axis Bank, obviously, and one of his views, you know, we were just discussing, and one of the views that was there is that potentially there could be an interest rate hike in 12 months, 12 to 16 months within India, and that cycle starts off again. So in line with obviously, while interest rates may decrease in US or wherever else, I think if that kind of starts moving upwards, in terms of what you all said, right, the markets will obviously price that, valuations will go lower, and then, you know, the market for P's actually open up. I just thought I'll kind of add that.
So thank you so much. With that, we come to end of the formal proceedings for the day. I'll request all the panelists to please come forward for a group picture. Once again, I would like to thank to our sponsors, Brand Capital, IDTA, Stake Board Capital, Gaja Capital, TVS Capital, IVA Cap Ventures, Pavestone Capital and Chris Capital for making this event possible. We also thank our knowledge partners, AVA Insights, AZBN Partners, Kroll, Pioneer Legal and Veris Law. We would also like to thank Probus Ventures for their support. But last but not the least, thanks to all the speakers and the very engaged participants. Now I would request all of you to please join us for networking over coffee and tea. Thank you so much for being here.